Welcome to Talk Tickers. This is the premier earnings call summarization deep dive. And man, it is a great day to be looking at turnaround stories.
Oh, absolutely. The market is it's hungry for a good turnaround right now.
Right. Because, if you look at the broader environment, discretionary retail is just getting absolutely crushed.
Yeah, totally crushed.
Consumer brands are, issuing downside revisions left and right. But then we get today's subject,
which completely bucked the trend.
Exactly. We're talking about Playboy, ticker symbol PLBY. They just posted a massive 15% overnight stock surge.
And it wasn't a fluke either.
No, not at all. They didn't do it by just selling more magazines or riding some weird temporary consumer fad.
Right. It was structural.
Yeah. They executed one of the most just ruthless margin-expanding corporate crash diets that Wall Street has seen this entire year.
It really was a crash diet. That's a great way to put it.
So if you're an investor looking for that elusive inflection point, where a legacy narrative structurally flips into a hardcore cash-generating reality, this deep dive is going to demand your attention.
We're not doing a nostalgic look back at a legacy media brand today.
Definitely not. We are doing a hardcore financial dissection. So let's just get straight to the headline results, right? The numbers that triggered this aggressive upward repricing.
Lay them out.
Okay, so Q4 GAAP earnings per share came in at 3 cents.
Which, wait, the street expectation was what? Like a penny?
Yep, hovering right around a penny. So we're looking at a clean 2-cent beat on the bottom line.
That's solid.
And revenue hit $34.9 million. That cleared the consensus by about $1.4 million. So it's growing at 4% year over year.
Which is, that's a highly anomalous growth figure when you look at the discretionary environment right now.
Right, because everyone else is sinking.
Exactly. Retailers are fighting tooth and nail just to hold their revenue flat. So generating 4% top-line growth while undergoing a massive restructuring. That's a huge signal of brand resilience.
And the market's reaction completely confirms that, institutional capital is viewing this as a material shift. This stock caught just an undeniable bid.
Oh, it surged.
It really did. Surged from a regular session close of $1.77 all the way up to around $2.03 in early pre-market trading.
That's nearly a 15% pop.
Yeah, and it wasn't on light algorithmic trading. We are talking heavy, high conviction volume here.
Oh, heavy.
Almost 2 million shares traded, specifically 1.94 million compared to their average daily volume of just 1.1 million.
Wow, so they almost doubled their average volume.
Yeah, investors were aggressively accumulating this equity.
Well, you don't see that kind of pre-market volume on just a minor revenue beat. That type of violent upward repricing happens when the fundamental thesis of a stock changes overnight. The market is looking past that superficial brand legacy, and they're seeing a highly calibrated financial engine now.
And that's our mission for this deep dive. We're going to deconstruct exactly how that engine works.
We really need to dig into the why. Why is the market rewarding this print so heavily?
Exactly. We're going to look at their aggressive deleveraging, their shift to this asset licensing model, the UTG China transaction.
Which is massive, by the way.
Huge. And we'll also look at the hidden gem of their direct-to-consumer portfolio. Because, look, a revenue beat in isolation means nothing if the cost to generate those dollars is awful.
Right. You can't appreciate a revenue beat without looking at the margin expansion. We have to look past the top-line summary.
So let's scrutinize that operational efficiency, the stuff that actually drove the EPS beat. Walk us through the income statement swing.
Yeah, so the income statement reveals a really severe, successful operational pivot. Net income swung to a positive $3.6 million in Q4.
Wait, positive 3.6? What was it, a year earlier?
A $12.5 million loss.
Oh, wow. So that's what, a $16 million positive swing?
Exactly. A $16 million positive swing on the bottom line in just a 12-month period.
That is insane.
Right. And when we isolate adjusted EBITDA, it came in at $7.1 million, which actually marks the fourth consecutive quarter of positive adjusted EBITDA.
So they've established a real trend line of operational cash flow here.
Yeah, and management noted it would have actually been $8.0 million if you exclude some specific one-time litigation expenses.
Okay, but a $16 million bottom line swing doesn't just, materialize organically from 4% revenue growth. the math doesn't work.
No, it doesn't.
So management had to have just taken a chainsaw to their expense structure.
They absolutely did. Operating expenses fell 15% year over year. They dropped it down to $32.2 million.
15% is a huge cut.
It is. But the underlying composition of that drop is the really critical piece of data here, because Q4 SG&A expenses were actually heavily burdened.
Burdened how? Like extra costs.
Yeah. They absorbed roughly $1.2 million in transaction fees tied to their deal making, plus an extra $2.1 million in brand marketing.
Wait, really? So they absorbed over $3 million in extra strategic and marketing costs, and their OPEX still fell by 15%.
Exactly. The fact that it still fell shows incredible cost discipline.
I mean, it's like going on a corporate crash diet, but instead of losing muscle, you're actually increasing your power output.
That's a perfect analogy.
Right. Because normally, a 15% OPEX reduction means you hollowed out your sales team or something. It usually leads to top-line contraction.
Yeah, usually you're cutting bone. But here, they're trimming the bloated operational fat while simultaneously growing revenue.
So how are they actually doing that? What's the underlying strategy here?
It's all about their asset-light pivot. That's the jargon management uses. They are actively moving away from being an inventory-heavy consumer name.
Okay, break that down for us. Why is inventory bad right now?
Because discretionary retail is just a brutal, uneven macro environment today. Unpredictable consumer demand, volatile supply chains. Holding physical inventory is basically holding trapped capital with obsolescence risk.
Right. If it doesn't sell, you're stuck with it and you have to mark it down.
Exactly. So by transitioning the core business toward high-margin licensing, they are outsourcing the manufacturing, the inventory risk, the distribution. All of it goes to third-party partners.
So they just operate strictly as the toll collector.
Basically. They're buying revenue visibility and margin resilience.
Well, cutting operational costs is great to stop the daily bleeding. But to truly survive a turnaround, you have to fix the balance sheet, right?
Oh, without a doubt.
And management just dropped a massive anvil on their debt load.
Yeah.
Which brings us to, honestly, the single biggest fundamental driver of this pre-market surge.
The UTG China deal.
Yes. The UTG China transaction. This is the surgical intervention on the balance sheet. Walk us through the mechanics of this deal they just announced in February 2026.
Okay, so the structure is designed to optimize immediate cash while keeping long-term upside. They are selling 50% of their China licensing business to UTG Brands Management Group.
50%.
Okay.
For how much?
$122 million in total cash consideration.
$122 million. But that's not all up front, is it?
No, the breakdown is very specific. It's $45 million upfront purchase price.
Okay, $45 million right away.
Then there is $67 million in guaranteed minimum distributions over the next 8 years, plus an additional $10 million in brand support payments.
And when does this actually close?
They expect it to close by March 31st, 2026.
Okay, I have to play devil's advocate here for a second.
Go for it.
China is like the largest scalable consumer market in the world. By selling off half of this asset, aren't they just mortgaging their future?
That's the immediate reaction a lot of people have.
Right. I mean, it sounds like they're selling off the crown jewels just to pay the credit card bill today.
I get that argument, but you really have to look at it through the lens of execution risk. That's the masterstroke here.
How so?
Operating a Western consumer brand in China involves severe regulatory hurdles, shifting local preferences, and logistical nightmares that routinely crush foreign margins.
So they're getting out of the operational headache.
Right. UTG Brands Management Group brings world-class local operational infrastructure. UTG takes on all that execution risk. Meanwhile, the company secures guaranteed cash flows and a huge upfront capital injection.
And they still retain the 50% ownership, so they keep half the upside profit share anyway.
Exactly. But honestly, the market isn't cheering just because it's a clever joint venture. The market is cheering because of the debt impact.
Right, how they're actually deploying that upfront cash.
Yes. Of that initial cash influx, they've earmarked nearly $52 million directly for debt reduction.
Oh, wow. $52 million straight to the debt stack.
Yep. And for context, they had already ground down their senior debt by about $58 million from Q3 2024. It was sitting at roughly $160 million.
So applying another 52 million instantly drops that senior debt load down toward the $100 million threshold.
Which is huge. That completely alters the institutional risk profile. It moves the company from being a highly leveraged speculative play into something fundamentally investable for funds with strict debt mandates.
And it's immediately accretive to earnings, right?
Yeah.
Because they're killing off all that interest expense.
Exactly. That capital is no longer servicing bondholders. It drops straight to the bottom line.
So this China deal really just proves the immense underlying value of their brand's IP. I mean, they extracted 9 figures of value just based on a trademark.
It's a massive proof of concept.
But the question then is, how does that IP translate into reliable cash flow in the rest of the world?
Right, the global licensing machine.
Because deleveraging is great defense, but they need to show offensive capability. Let's talk about the power of this licensing behemoth they've built.
The fiscal year 2025 numbers here are staggering. Licensing revenue topped $46 million.
46 million, that's what, like almost 40% of their total revenue?
Over 38%, yes. But the crazy part is the margin. It's operating at a massive 90% gross margin.
90%. I mean, that's like an enterprise software margin. You never see that in consumer brands.
Right, because the partners absorb the cost of goods sold. And even better, 90% of that revenue is contractually guaranteed.
Minimum royalty guarantees.
Exactly. They have over $343 million of unrecognized future revenue already legally locked in.
343 million. That's incredible revenue visibility. But wait, to keep those licensing partners happy and paying those guarantees, the brand actually has to stay culturally relevant, right?
Absolutely. If the brand equity decays, those licensing renewals evaporate.
So how are they rebuilding that media funnel to maintain relevance? Management called 2025 a defining year for cultural momentum, didn't they?
Yes, they did. And they're putting real talent behind it. They hired David Miller as president of media and brand, and Philip Picardi as chief brand officer and editor-in-chief.
Okay, so they're scaling the media arm.
Right. Their whole mandate is to use the original media properties, like the magazine, as a top-of-funnel loss leader.
Oh, I see.
For instance, management mentioned the upcoming magazine cover features a major female music star with over 70 million Instagram followers.
70 million. That generates a ridiculous amount of organic impressions.
Exactly. It injects the brand straight into the cultural dialogue.
It kind of reminds me of the Marvel Cinematic Universe strategy.
How do you mean?
Like, you know how a movie studio will spend $250 million on a blockbuster film? The movie itself might barely break even at the box office. But that's not the point. The movie isn't the main profit driver.
Right. It's a marketing event.
Exactly. It's the 2-hour commercial that gets you to buy the high-margin action figures, the lunchboxes, the theme park tickets.
That is a brilliant analogy.
The media side here, the magazine, the upcoming TV adaptation with Propagate, the feature film with Hefner Capital, that's their blockbuster movie, gets the partners to buy the high-margin licensing.
Spot on. But they're also figuring out how to monetize that digital audience directly, too. They aren't just relying on licensing trickle-down.
What's the plan there?
They're doing a full website rebuild launching later in 2026. Moving aggressively to a recurring subscription model.
What are the price points?
It's $79 for digital access and $149 for digital plus print.
Okay, that's premium pricing.
And in Q4, they launched this thing called paid voting. It's proving to be a highly scalable, recurring revenue mechanism.
Paid voting, how does that work?
It's fueled by daily user-generated content. Tens of thousands of independent creators host contests on the platform, and the user base pays microtransactions to vote for them.
Oh, wow. So the creators leverage their own audiences, bring them to the platform, generate the content for free.
Yep. The company just provides the infrastructure and collects the cash. Management said it has multi-million-dollar scalability.
That is incredibly asset light, pure margin. So licensing and digital subs are these great low-cost pillars. But there's one glaring contradiction sitting on their balance sheet, isn't there?
Oh, you mean the heavy physical brick-and-mortar asset?
Exactly. Honey Birdette.
Yeah.
The direct-to-consumer premium lingerie brand.
Which is absolutely crushing it, by the way.
It is. But it makes no sense strategically.
Yeah.
If the whole narrative is asset light, no inventory, why do they still own a physical retail operator? Let's look at the financials of lingerie, though, because they are concrete growth engines.
The Q4 stats for Honey Birdette are amazing. Overall sales were up 9%.
In a terrible retail macro environment.
Right. Digital was up 7%, but physical retail was the standout. Same-store, like-for-like sales were up 17%.
17% same-store growth is huge.
And geographically, the UK was up 36%, and the US was up 21%.
That is severe organic demand. Did they have to compress margins to get that volume?
Actually, the opposite. Gross product margin expanded by a massive 140 basis points, up to 77.8%.
Wait, how did they expand margins that much?
This is the craziest part of the call. To combat impending tariffs, management just instituted a flat 10% price increase across the board.
A 10% price hike.
Yeah.
Usually that destroys volume instantly. Consumers just trade down.
Exactly. But management noted they saw zero pushback from the consumer base.
Zero pushback. That is the ultimate macro flex. They have absolute pricing power.
It really is. They also pulled back on promotional discounts during a quarter where everyone else was slashing prices just to clear inventory.
So they held the line on price.
Yep. And it led to a 21% increase in full price sales. They even posted their best Valentine's Day on record.
Okay, but this brings me back to my main question. If the whole strategy is to become asset light and avoid the headaches of inventory, why hold on to this? Why are they actually planning to expand the U.S. store footprint for Honey Birdette?
It serves two purposes. First, it's a cash-flowing beast. It subsidizes the corporate restructuring and proves they can execute in the premium luxury space.
Fair enough. What's the second purpose?
First-party data and terminal asset value. In mid-October, they launched the Honey Club loyalty program. It snagged 80,000 members in just a few months.
80,000 premium tier members. That's a lot of highly targeted data.
Right. And management explicitly hinted on the call that this asset could serve as a strong monetization opportunity down the line.
Monetization opportunity. That is Wall Street code for a highly lucrative future sale or spinoff.
Exactly. They're building it up to sell it to private equity to further deleverage.
And in the meantime, they're cross-pollinating, right? They mentioned an upcoming Playboy capsule collection designed by Honey Birdette.
Yes, merging the two brand equities, using the legacy top-of-funnel awareness with Honey Birdette's premium retail execution.
It's a smart play. Now, physical footprint expansion isn't just happening in retail, is it? It's happening in hospitality, too.
But with a very clever asset-light twist.
Let's transition to that final tiller, hospitality. How does the new mansion strategy fit into this turnaround verdict?
So historically, corporate hospitality requires massive capital-intensive leases, right?
Oh, yeah. Huge build-out costs, ongoing operational liabilities. It's a nightmare.
Well, their plans for the Miami Beach membership club flipped that entirely. They signed a non-binding letter of intent to raise capital from third parties.
So someone else is paying for the physical build-out.
Exactly. And they hired a third-party hospitality operator to manage the day-to-day logistics and staffing.
So what does the company actually do then?
They limit their capital risk to almost zero. They just participate via licensing fees, a cut of the membership revenue, and brand association.
That perfectly encapsulates the new business model. They get a flagship physical presence in Miami, but they don't wreck the balance sheet with commercial real estate liabilities.
It's brilliant.
So let's zoom out for you, the listener, and look at the macro context. Over the last year, this stock is up roughly 51.3%.
Which absolutely crushes the Russell 2000 and the consumer discretionary benchmarks.
Completely crushes them. However, it had lagged over the last month leading into this print, down about 9.7%. What was driving that sentiment divergence?
Well, management spent a lot of time on previous calls talking about cultural momentum and modern masculinity and editorial direction.
Which is all very qualitative.
Right. And the market didn't bid the stock up 15% today because of cultural momentum. Institutional capital doesn't care about editorial pivots.
So why did they bid it up?
They bid it up because of cold, hard cash, debt pay down, the UTG deal, and quantitative proof that this licensing model produces real EBITDA. The market just loves this narrower, financially disciplined story.
They want the math to work.
Yeah.
And this quarter, the math worked.
Exactly.
All right, let's wrap this up for you. The Talk Ticker's thesis is clear. This is no longer a sprawling, cash-burning lifestyle media brand.
Not at all.
It is a lean, rapidly deleveraging, high-margin royalty machine with an embedded, highly profitable retail call option in Honey Birdette.
That sums it up perfectly.
Which means it is time to dramatically shift gears. We've done the rigorous analysis, but now it's time for our signature Talk Ticker segment.
Here we go.
This is not financial advice segment. I am going to pitch a wild, outrageous, but plausible trade idea. like a hungry hedge fund pod analyst pitching the investment committee.
Let's hear the speculative thesis.
Standard disclaimers apply. I am not a fiduciary. This is strictly for informational and entertainment purposes. Definitely not financial advice.
We legally have to say that.
Yes, we do. So here is the pitch. I call it the Honey Trap Spinco Arbitrage.
The Honey Trap Stinco arbitrage. Okay, I'm listening.
The play is to go long the equity right now, aggressively.
Okay.
And it's based on a hidden catalyst that I think the market is completely mispricing.
Tied to the monetization opportunity management hinted at.
Exactly. The trigger is the Honey Birdette Loyalty Club. They snagged 80,000 members basically overnight. My thesis is that the precise moment that club crosses 250,000 members, management is going to execute a total spinoff or direct sale of Honey Birdette.
To a private equity firm.
Yep. A PE firm drawn to those 77.8% margins, the zero consumer pushback on a 10% price hike, and the pure pricing power against tariffs.
PE firms are starved for direct consumer targets with those exact metrics. It commands a premium multiple.
Exactly. So management secures this massive 9-figure cash windfall from the sale. What do they do with it? They take that cash and instantly wipe the remaining senior debt, which is sitting around $100 million after the UTG deal. They wipe it down to absolute zero.
Functionally completing the balance sheet turnaround in one move.
Yes. And what do they do with the leftover cash from the sale? They issue a massive special one-time dividend to the remaining equity holders.
That is aggressive, but it is structurally plausible.
Right. Because with the UTG deal already knocking the debt down, a premium sale of Honey Birdette mathematically clears the board.
And what are you left holding?
You're left holding a pure play 90% margin licensing shell that just prints free cash flow with zero debt. It basically becomes a dividend-yielding royalty trust.
That is a fascinating arbitrage theory. It perfectly synthesizes the margin expansion and the debt reduction mandate.
I'm keeping an eye on it. But before we sign off, I want to leave you with one final provocative thought, something to explore on your own.
What's that?
We've praised this asset-light pivot all day, outsourcing manufacturing, inventory operations. But if a company completely ceases the internal production of its own core products, if every physical interaction a consumer has with the brand is made and managed by a third party, does the underlying IP eventually hollow out?
That is the big risk.
Right. Can you sustain a 90% licensing margin indefinitely if you aren't the actual architect of the products anymore? It's the danger of the corporate crash diet. You cut the fat, but eventually you have to prove you haven't outsourced the soul of the company.
A great question to ponder.
Definitely. Well, we'd love for you to reach out with your own thoughts on the viability of this asset-light turnaround. Thank you so much for tuning in to this deep financial deconstruction.
See you next time.
Keep analyzing the anomalies.